We have 3 stocks trading at or near 52-week lows, and these are what our community voted on inside of Everything Money. So why do we look at companies that are at 52-week lows? Well, it's a great place to start. It's a great place to find possibly hidden value. There's usually a reason why stocks are falling out of favor. And when they start to get to their 52-week lows, prices can get very interesting, and that's why we take a look at these. So stock number 1, Pepsi. Everybody knows Pepsi. Pepsi is at $165 a share right now. Let's see what the 52-week low is. It is just a few days ago, $155.85. Now, this is an interesting company because when we start looking at some of the main metrics of them, look at the market cap, $226.71 billion, and you come down here to the enterprise value, very, very interesting. $300 billion. The difference is the debt. I would expect to see on a company like this, where you see a higher market cap, maybe they would be switched, 300 billion here, 226 here. That's not the case. This is a company that really doesn't have to deal with any debt, and that is a great thing when we're starting to look at big companies, especially these conglomerates. Let's look at a couple of other things. Return on invested capital. I absolutely love that. Anything higher than 10% to me, especially when we're looking at something with a market cap of nearly $250 billion, that is a very rare thing to see. It's rare to see companies this large that are very good at reinvesting in themselves. If we come over here to the gross profit margin, very large number, about 55%. The profit margin is very stable at about 10%. Anything else that I'm noticing here? The dividend. Okay, so I don't like that. So they have a 3% dividend that pays out $7 billion. Their average 5-year free cash flow is 6.52. So they are paying out more money. And this is what I don't like about these companies. When you think about companies like AT&T, Pfizer, Pepsi, probably Coca-Cola, maybe Coca-Cola is a little bit different. I hate when they just pay a dividend for the sake of paying a dividend, especially when you have a return on invested capital over the last 5 years of 14.5%. Why are you not going and investing in yourself? Why are you not doing other things to grow the value of the company that way versus paying out some dividend that you really can't afford at this point based on the cash flow that's coming in? But we'll leave it there for now. Now, also, when you look at this, free cash flow is pretty significantly lower than the net income. So there's a couple of good things here, a couple of bad things here. I like to see free cash flow a little bit higher. I don't like to see this dividend. This I like, but if you're not utilizing it, what the hell is the point? The return on invested capital is growing too. You can see that it's increasing over the last 12 months. So let's look at the 8 pillars here real quick and see what we have. All right. I like to see that our shares outstanding are sitting relatively the same. The 5-year free cash flow number and the 5-year PE, not terribly surprised. This, after what we just saw on the other metrics chart, I'm not surprised about. This, I'm really not too worried about it. I like to see the revenue growth, and this is the most important thing. Cut the dividend and start reinvesting in yourself. That's what I don't understand. Why are you not reinvesting in yourself when you have the capability to do so, especially at the scale that they do? Pepsi is a global brand with consumption figures that truly boggle the mind. Worldwide, the brand claims about 23% of the soda market, a significant share compared to Coca-Cola, which has the dominant 45% number. This means that nearly 1 in every 4 sodas consumed across the globe is part of Pepsi's vast portfolio, which includes heavy hitters like Mountain Dew, Gatorade, Tropicana. But they aren't just a beverage company. Every day, over 1 billion servings of Pepsi products are consumed globally. 1 billion. And they have a snack division that generates more revenue than the beverage division. In the US alone, Pepsi products hold a commanding 30% of the soft drink market and 23% of the global snack market. The Lay's brand alone produces 4 billion bags of chips annually. The only company with a larger revenue and snack space is Nestle. And in fact, Pepsi is 2 times larger than Mars, which holds the 3rd largest snack revenue globally. Think about that. Now, let me show you these brands. This is absolutely wild. And to me, I thought of Pepsi as like Pepsi, Aquafina, that's about it. But look at this. Aquafina, Brisk, Bubbly, Captain Crunch, and we think about the snack brands, Doritos, Cracker Jacks, that's been there for quite some time, Grandma's, Gatorade, Fritos, Funyuns, This Jack Link's beef jerky, Life Water. I've seen that everywhere. Let's continue here. Miss Vicky's. That's a chip that I know a lot of people like. Muscle Milk, Ocean Spray, Popcorners. That's supposed to be your healthy popcorn chip thing. Leaf, Pure Leaf, Quaker, Ruffles. Oh my goodness. So they have partnerships with Starbucks. Spitz, which are the best sunflower seeds out there. If you haven't had them, try them. Tazo, SodaStream in general. Sobe. I didn't know Sobe was still around, but apparently they're still doing something. This is just astounding to see not only the beverage brands, but the snack brands that they command. All right, now let's go check out these analyst estimates and see what they have to say about Pepsi. So, all right, much bigger than I expected. Going from $8.23 the end of this year to the end of 2028, $10.75. It's actually mid-single digit growth. It's higher than I would expect them to have on that side. And on the okay, this is more of what I was expecting, but I expected it to be kind of the same. So if we look at the revenue side, going from $93 billion to $115 billion, I mean, mid-single digit growth, which is still rather high. I was actually thinking it would be in the 2 to 3% range, but hey, if analysts tend to be a little bit more aggressive than me, doesn't mean that they're right, doesn't mean that they're wrong. Just kind of gives us a guidance of saying, okay, where do we think that things are going to be? So let's put in some assumptions to see what we would pay for Pepsi to make it almost of value for us going into the future. So when we look here at the stock analyzer tool, it breaks it down into different categories, and these are different assumptions that I'm going to make over a certain year period. For this example, I'm going to use a 10-year period because when I typically invest in companies, I like to sit in them for an extended period of time. So I'm going to put in a revenue growth assumption, just like we saw on the analyst estimates. I'm going to put in a profit margin assumption, which they can do over a 10-year period, free cash flow margin, PE, price to free cash flow, and then I'm going to put in a desired rate of return, which is my margin of safety, which is going to give me a little bit of a buffer of where I go. And then it's going to tell me a couple of numbers down here, what I should pay and what kind of return I'll get over the 10-year period. So let's put in some numbers here. So revenue growth, analysts thought it was going to be in that mid-single digit range. I'm going to go with 1, 3, and 5%. I'm going to give myself a wide range here. Profit margin, they've been incredibly consistent at 10%. I kind of want to just put 10% across the board. Free cash flow margin, slightly lower, historically lower. So let's go with a consistent, actually, you know what, let's do, because decreasing. So let's put in 7% across the board. I typically don't put the same numbers across the board when it comes to those assumptions, but when I see a company that's basically doing the same return over a 10-year period, because this is a 10-year, 5-year, 1 year. Over that 10-year period, I'm going to just stick with it. PE, I do think there's a premium to pay here. I'll go with a little bit higher than I normally do. And for my return, I'm going to put in a 10% return, an 11% return, and a 12% return. Why would I increase these numbers here? Well, it's definitely going to be harder for them to do 5% revenue growth versus 1% revenue growth over a decade, right? Therefore, I should have a higher rate of return, or I should expect a little bit more, because if they do 5%, which is going to be challenging, I need to have a little bit of a buffer in there, make sure that I'm making the right assumptions. So let's go ahead and click Analyze and scroll down and see what we have. All right, so if I were to buy today, these are the numbers that I should be paying today based on the assumptions that I put in, and these are the returns that I get. So if I bought today based on those highest assumptions, I would get a 3.48% return over the next decade. If I bought at the lowest assumptions, I would get a negative return over the next decade. But you could see that my range is, I'm going to go with the multiple of earnings, 91 to 121. You can see that we're at 164. So even though the stock price is down and it's at 52-week lows, it's still a little bit expensive for my taste. And if we just go back here and we click on the metrics, you can see here, what's that PE sitting at? PE sitting at 26. So that's kind of where I'm thinking that maybe we're still a little bit overpriced. Do I want to pay a premium for Pepsi? Yes, maybe not this much of a premium. Now, stock number 2, Lam Research. This is a stock that was requested by our community. And if we just scroll down here, Lam Research is one of the largest semiconductor water fabrication equipment manufacturers in the world. They specialize in deposition and etch This is all Chinese to me, but let's go and look through the metrics because we could still break it down. If we look at the market cap, it's another one. Market cap, about 93 billion. Enterprise value, higher than the market cap. Very interesting. I like seeing that kind of stuff. Let's look at our return on invested capital. Let's just go in the same order. 5-year return on invested capital, 29.5%. Now, over the last 12 months, it's slightly lower. So we're going to want to pay attention to that. Is that something that's going to ebb and flow over time? Is it steadily declining? Is this just an off year? Is there something that has thrown off the return on invested capital? We'll figure that out. If we come over here to the PE, it's about 23.5 over the last 5 years. It's pretty consistent. It's about 23. Gross margins, I actually would expect a little bit higher gross margins. Now, I do like that the profit margin is increasing, ever so slightly increasing, but increasing. But there's things on here that I like. Now let's look at this dividend. More than affordable dividend. Again, it just bothers me when a company goes out and pays even a dividend like this, $1 billion. You're paying $1 billion, paying 25% basically out of your free cash flow when you have a return on invested capital of 26%. I just don't understand why companies do this. I just don't get it. Let's see here. Let's go to some financials here. Let's see. Are they buying back any shares? They are buying back shares. What was the PE? Okay, maybe not the worst thing in the world. Let's check out the 8 pillars here. So really, the only two things that are red are our valuation metrics, 5-year price to free cash flow, 5-year PE, and they're ever so slightly over. To me, this is definitely saying go and take a look at this because this is not much. We're 23.46. My setup is for 22.5. Everything else is telling me things are good. Can't say I absolutely love this. Basically, the two things that I don't like so far. Can't say I love the shares outstanding, that they have this buyback program. And not only that, let's look and see where we are at here. So let's go. Okay, so they've been buying back shares. If we just look at this chart, they've been buying back shares all along the way. So even when they were at $110 a share, they were still buying back shares. I don't like seeing that. I don't like companies that just buy back shares to buy back shares. It doesn't make sense to me. Doesn't make sense to them either. But hey, it is what it is. Let's see what the analysts have to say here. Analysts, whoa. I don't know what that big jump is in 2028. I'm actually going to omit that. I'm just going to look here. We're looking from June of 24, already passed, to June of 27, basically going up at a mid-teens rate on the earnings per share side. And if we go to the revenue side, 15 billion to 23 billion, not as much growth as I expected, to be honest with you. I think on the high side, maybe we'll put in 8% in Stock Analyzer tool. Now, before we get any further, let's talk a little bit more about Lam Research. Lam Research is revolutionizing the semiconductor industry with its cutting-edge technology that powers everything from smartphones to supercomputers. Join the club. Specializing in etch and deposition systems. This is what I talked about before, where I don't really understand what they are. If you're interested in a company like this, go find it out. So Lam ensures the creation of tiny, high-performance chips by precisely moving material and laying down ultra-thin layers that form the foundation for the modern electronics. There are actually videos that you can go watch on YouTube that kind of show you this process. It's actually pretty cool. These innovations are crucial in the race to shrink chip sizes and increase its functionality. Over 60% of their revenue comes from advanced semiconductor systems. Lam has a strong recurring revenue component to their business with $1.78 billion from its customer support services. The company's footprint is global with about 37% of its revenue tied to China. Competitors include Semis, Tokyo Electronics, ASMPT, Applied Materials, KLA, ASML, and Incor Systems. In terms of market share, Lam comes in third with 7.52% of the market share versus ASML with 15.5% and Applied Materials with about 13.5%. So with all that said, let's go look at Stock Analyzer and see what price that we can put on this bad boy. So if we come over here to Stock Analyzer, let's make some assumptions. Now, the first thing that I notice here, before I go any further, over the 10-year period, they're about 24.5% of ROIC. Then they climbed. So there was a climb somewhere in the last 5 years and over the last year. So I like to see this. This makes me say even more, why are you paying this dividend? You're really good at investing in yourself. Stop doing that. Now, when I look at the revenue growth, when I see a number like this, I'm not gonna put too much weight into that. But let's go here and let's do 5, 7, and 9%. And you may look at this and say, well, why would you put in 5, 7, and 9 when it was 12.6 and 10.4? Well, this number is starting to decline. Clearly, there was something here that happened that is bringing it down. Now I'm saying to myself, okay, well, now this number has to go back up. So over the next decade, I think that I'll be comfortable with 5, 7, and 9%. So that's kind of how I rationalize my way to that one. Profit margin is increasing. That's great to see. Let's go with 25. Let's go with 25, 26, and 27%. And I'm actually going to do the same thing for the free cash flow margin. These numbers should equal out to be about the same over that period of time. I'm going to go 17, 19, and 21 here. I do think there's a premium to pay with as much market share that they actually have. And I'll go with 11, 12, and 13%. Now, with a growth company like this, where things are constantly moving, and especially in the semiconductor space, everybody is fighting for market share. You're going to want to have discussions about these kind of companies rather than just going in and buying them. This is one of the stocks that's discussed regularly throughout our community. Remember, our community voted for it to be in this video. Now, if you've actually visited our community, you'll notice that there's a waiting list going on. Today's software includes everything that we offer, from stocks to retirement to real estate. We are making some changes behind the scenes, so that offer will be gone soon. Remember, Paul built this software selfishly for me and our team, and we use it all the time, and it's going to continuously get better, especially in the world of investments and stocks, making the right decisions on your future and your retirement. But as we've grown, it's become less about us and more about you and how we can better serve you. This is why we are updating our software to give you exactly what you need. Now, the good news is we haven't made these changes yet. So if you join today, you'll be grandfathered in for life with everything. And this is the best deal that we've ever offered so far. I'm telling you this now because there's still time for you to sign up. As long as you've joined the Everything Money community, before the changes are made, you will keep your plan even after the changes are launched. So click on the link in the description below and get access to everything that we have to offer, including all of our investing tools and, most importantly, the community. It will be the best investing decision that you have made all year. So now let's go look at the results from the assumptions that we made. Click Analyze, scroll down here. Okay, this could be interesting. So if we go off of the highest assumptions, these are the assumptions that we made. $71.64 is what we should pay today. You can see that the current price is below that. And if everything hit right here, even with our margin of safety, we would get about a 13.2% return over the next decade. You can see on the low end, it's about $50. In the middle, it's about $6. So depending on the assumptions that you think are most correct, and you do your own assumptions, this is kind of where we're going to stand. And if we change this to go without any margin of safety, this means that we're just buying and we don't have any margin of safety in there. You can see how the numbers change. It's about $90 with about the same return. Current price is not going to change, obviously. And it's about 50 and 70 in the middle. So you need to determine where and what assumptions you're going to make. And this is where the community helps out so much. All right, third stock, CVS. This company has been battered and abused, that's for sure. So if we just come down here and look at some of actually, let's look at this first. $59 a share right now. The 52-week low is $52 a share. So it's a little bit over. That was just about a week ago. The 52-week high is 83, and the all-time high is 113. Dang, that is some abuse. So let's look at these. Oh my goodness gracious. Okay, so if we look at some of these things, market cap of $75 billion. Look at this enterprise value, guys. Sheesh. Okay, let's see what they pay out in a dividend. This is the thing that starts to worry me about CVS. So if we look at this and we say, okay, this is a company that pays about 4.5% dividend. It's $3.3 billion. Over the last 5 years, can they afford it? Yeah, but they were a very different company over the last 5 years. Now they have a free cash flow of $1.69 billion. How are you doing this? Return on invested capital. 6%, nothing to write home about. And you can tell that it's decreasing slightly, but decreasing. 5-year PE, look at the price to sales ratio of 0.2. The 5-year PE is 11. We're about a 15 PE right now. Gross profit margins of 14%. And this is important to look at, guys. You have a 5-year profit margin of 2%, and over the last 12 months, you're at 1.36. So the profit margin is declining. That's not something that is very good. And man, all right, let's go and look at the 8 pillars. Actually, I want to look here just real quick. The revenue is still up. Okay, revenue's still up. So this is going to start to tell the story, right? They are buying back some shares. Their debt we saw is, actually we didn't see it, 7.68. I'm not terribly worried about this. They have a ton of brick and mortars just sitting out there. A lot of it probably has to do with leases. Obviously, your 5-year PE and your 5-year price to free cash flow are going to come in soundly. I'm worried about the cash flow. I'm worried about the net income growth. There's a lot of things that I'm worried about here. This is another one where I would not hesitate to chat with the community about. And with that, CVS has fallen recently due to a combination of factors. They've had declining profit margins in its retail pharmacy stores. They've increased costs with its insurance division of Aetna. They have repeatedly cut their earnings outlook. They've had recent layoffs to cut costs. Their recent replacement of their CEO, Karen Lynch, to David Joyner. What does this all mean going forward? There's a lot of moving parts here. Well, CVS, they're still a leader in both the retail and the healthcare space with over 9,000 locations, ensuring 85% of Americans live within 5 miles of a CVS store. Just think about that. Each year, the company serves millions of people through its Minute Clinics, the pharmacy services, the innovation of its digital solutions, processing more than 2.3 billion prescriptions and pharmacy claims per year. Polls that have been taken have shown that CVS pharmacists are trusted by 81% of consumers. That's a very large number, further cementing their role as a credible healthcare provider. Now back to Aetna. CVS acquired Aetna in 2018. Some of you may remember this. And it was a game changer for both companies and really the broader healthcare industry. Valued at $78 billion, the deal was a major move towards integrating healthcare services, with CVS now combining its extensive network of retail pharmacies and Minute Clinics with Aetna's insurance capabilities. The acquisition also gave CVS a unique opportunity to reshape healthcare delivery with a focus on local, convenient care, reducing the reliance on costly emergency rooms and hospital visits. Now, with all of that being said, let's see what the analysts have to say about all that and how they digested that information. So if we come over here and just click on analyst estimates, I am actually, I'm surprised by this. $5.35 this December, it's November right now, through 2028, $10.60. I'm actually shocked by this number. I thought that it was going to be declining. Let's see what the revenue is doing. Okay, revenue growth. So maybe this is something interesting to look at. I think if anything in this space, management is my worry so far. And that's just kind of what popped into my head right now. $376 billion going to $456.5 billion. It's about, let's call it 4.5% revenue growth over the next 5 years. 5 years, 4 years. All right, now let's put some numbers into Stock Analyzer. Okay. Now, revenue growth. Okay, the return on invested capital, like I talked about it right when we pulled this up and looked at the main metrics, declining. Profit margins, declining. Okay, free cash flow margins, declining. Oh boy. Revenue growth, obviously declining. So let's put in some stuff here. This is going to be, I feel like this is going to be a turnaround play-ish. So let's go with 2. You know what? Let's go 2, 4, and 6. And some of you may think that this is rather low, but I'm going to go 1. I'm going to go 1.5 and 2. And over here, oh my goodness, I guess I'll go with 0.5, 1 and 1.5. PE. I just don't think that there's anything that's going to get their unless they sell something off. If they sell something off, everything's going to change here. Let's go with 13, 15, and 17. 13, 15, and 17. And then their desired return, I'm going to go 12, 14, and 16%. Why so high? Because like I just said, this could be a turnaround play. This could be something hard to understand. So based on my assumptions, let's see, current price is about $60 a share. Okay, I think we should go off the multiple of earnings. I don't think we should go off of the free cash flow at this point in time, but let's look at it anyways. So on a high side, about $56 to $75. Remember, this if everything hits with that large margin of safety. On the low end, $16 to $32, 12% margin of safety. If you bought it today, you're going to get a negative return over a 10-year period. And the middle is about $35 to $50. This is a hard one. This is another one that is very important to chat with in the community. I think that it is very important to have these conversations. Now, there are 3 other stocks that the community has requested us to analyze. You can click right here and go watch Paul analyze them.